Previous videos, we focused on payroll from the employee's perspective, calculating gross pay, deductions, net pay, and recording payroll transactions. In this video, we'll shift our attention to the employer's responsibilities after payroll has been processed. Employers are responsible not only for paying employees, but also for calculating, depositing, and reporting various payroll taxes. Some payroll taxes, such as Social Security and Medicare taxes, are shared between employees and employers. Payroll is not a single transaction. It's a process with several steps. First, employers calculate gross pay. Then they withhold taxes from employees' paychecks. But that's only half the story. As already mentioned, employers must also pay their own share of certain payroll taxes, deposit taxes on time, and file multiple forms with the IRS and Social Security Administration. Missing any step can result in penalties even if employees were paid correctly. The accounting team must also record the expenses, deductions, and liabilities from the payroll register in the general journal and post them to the general ledger. In prior videos, I've talked about the first two steps, and we're now ready to talk about the employer's payment of payroll taxes. Once payroll taxes are calculated, employers must deposit those taxes with the IRS. These deposits include federal income tax withheld from employees and both the employee and employer portions of Social Security and Medicare. The important thing to remember is that you absolutely must pay the taxes by the due date. The IRS is very strict about when deposits must be made. Also, the IRS prefers electronic payments and requires electronic payments if the annual federal tax deposits are more than $200,000. Employers who are required to make electronic deposits and do not do so can be subject to a 10% penalty. Now that we know why it's so important to pay the required taxes on time, let's talk about the actual due dates. How often and when you pay the tax amounts depends on the actual tax liability, not how often you pay your employees. So just because you have a semi-weekly payroll doesn't mean that the employer's tax deposits are due semi-weekly. The IRS uses a look-back period to determine how often an employer must deposit payroll taxes. Depending on the amount owed in prior periods, deposits may be required monthly or semi-weekly. This does not change how much taxes is owed, only when it must be paid. Late deposits can result in penalties even if the correct amount is eventually paid. So let's look at the graphic. If the payroll tax liability per year is less than $2,500, then the tax deposit is paid quarterly when the employer files the payroll tax return. Now, if the payroll tax liability is greater than $2,500, then we have to look at the amount of payroll tax during the look-back period. The amount was less than $50,000, then the tax deposit is paid monthly by the employer by the 15th of the following month. The tax liability is greater than $50,000 during the look-back period, but not more than $100,000 during a payroll date. Then the tax deposit is paid semi-weekly, so twice per week on either Wednesday or Friday, depending on the day of the week the payroll is paid. There's a special rule, though. If on any payroll day the tax liability exceeds $100,000, the tax deposit must be made on the next banking date. This is pretty common in my experience when year-end bonuses are paid and the tax liability significantly increases from a regular payroll period. The quarterly payroll register is a summary document that shows us payroll activity for 3 months. It typically includes each employee's gross wages, taxes withheld, and net pay. The level of detail depends on who is using the payroll register. The payroll department needs a very detailed payroll register, whereas the accounting team needs a payroll register with just enough information to properly tie out all payroll journal entries for a 3-month period. At the end of each quarter, employers must report to the IRS what the business paid to employees and all the federal taxes, Social Security and Medicare taxes on Form 941, the employer's quarterly federal tax return. At the top, we have the section where we enter the employer identification number and the company name and address, and to the right of the company information, we put an X on the line that shows the correct quarter that the Form 941 is being completed for. Our example, that is the first quarter of 2021. The next section is Part 1. In Part 1, we enter the number of employees who received wages on March 12th, which is 5 employees, and we enter the taxable earnings from our payroll register on line 2. The income taxes from our payroll register is entered on line 3. Next, we enter the Social Security taxable wages on line 5A and multiply that amount by 12.4%. Why 12.4%? Well, because the employer has to remit the 6.2% withheld from the employee, but also has to pay the employer portion of 6.2%, combined 12.4%. The taxable Medicare wages are entered on line 5C, and we multiply that amount by 2.9%, which represents the employee and employer portion of 1.45% each. On the next line, line 5D, we enter any Medicare wages subject to the additional withholdings. However, that doesn't apply in our example. So the next step is to sum up the Medicare and Social Security tax liability on line 5E for a total of $4,470.28. On line 6, we combine the total Social Security and Medicare taxes and add the income tax for a total of $6,485.28. There are no further adjustments, and we enter $6,485.28 on line 10 as well and continue to page 2. On page 2 of Form 941, we see that we don't have any further adjustments that apply and enter the amount of $6,485.28 on line 12. The deposits are entered on lines 13A, 13G, and 13I, and because the total tax equals the total deposits, no additional tax is due. In Part 2, the employer enters the tax liabilities by month, in this case $1,995.52 for month 1, month 2, and $2,494.24 for month 3. On page 3 in Part 5, the employer signs under penalties of perjury and mails the return. Signing a document under penalties of perjury is to be taken very seriously. A person convicted of perjury under federal law may face up to 5 years in prison and fines. The punishment for perjury under state law varies from state to state, but perjury is a felony and carries a possible prison sentence of at least 1 year plus fines and probation. Unemployment taxes are designed to provide temporary financial support to workers who lose their jobs through no fault of their own. And the common misconception is that employees pay unemployment taxes, which is not correct. Employers almost always pay both the federal and the state unemployment taxes due. There are 2 systems, the federal and the state system. The federal unemployment tax rate is 6% less a state unemployment tax credit of 5.4%, making the actual rate 0.6%, which is the 6% minus 5.4%. The state unemployment tax rate is based on the company's experience rating, meaning that it varies from company to company. Just like Social Security tax has a maximum wage amount, so does unemployment taxes. The federal wage limit is $7,000 for federal unemployment taxes, and each state has a different wage limit, so it's important to check that. Now, typically, unemployment taxes is calculated and recorded each payroll period, and that is what SB Express Company does in our example. For the payroll period ending January 6th, we're using the wages of $2,247.50 from the payroll register and multiplying them by 0.6% for $13.49. In our case, the state unemployment taxable wages have the same maximum wage base as FUTA and a tax rate of 4%. So we multiply $2,247.50 by 4% for $89.90 of state unemployment taxes and arrive at a grand total unemployment taxes of $103.39. Now, in most states, the due date for the state unemployment tax return is due quarterly. Federal unemployment taxes are paid quarterly, but the tax return is filed annually with Form 940. This is the annual Form 940, the employer's annual federal unemployment tax return. The return is due by January 31st of the following year, but the due date is extended to February 10th if all tax deposits were made on time. Let me walk you through the process of how to complete this form step by step. At the top, we have the employer section where we list the employer ID number and then the company name and address. The section to the right is only completed if this is an amended return, a successor employer to indicate that there are no payments to employees, or that the business closed. In Part 1, we fill in the abbreviation for the state, where the business paid unemployment taxes, or if there are multiple states, the employer would complete Schedule A. Now in Part 2, Box 3, we list total payments, but list in Box 5 the amount that are above the threshold of $7,000 for each employee. In this case, $81,870. We subtract that amount from the total wages to arrive at the FUTA taxable wages from the payroll register. And we then multiply the taxable wages by 0.6% to arrive at the FUTA taxes of $210. If there are any adjustments, they are listed in Part 3. We subtract any deposits from the calculated FUTA taxes to arrive at the balance due or overpayment in Part 4. In Part 5, the employer lists the FUTA tax liability by quarter if the amount on line 12, the total FUTA tax after adjustment, is greater than $500. Part 6 is used if the form was completed by someone other than the employer and the employer grants permission to contact that person. And then the employer signs and dates the form and prints the name, title, and phone number. At the end of the calendar year, employers summarize all payroll records for the year and provide the Form W-2 to each employee by January 31st of the following year. The information from Form W-2 comes from the employee's earnings record. 2 Form W-2s are given to the employee, 1 copy to the Social Security Administration to track your Social Security benefits, and the Social Security Administration shares the information with the IRS, 1 copy to the state tax agency and a copy for the employer. Now what you see here displayed as the Form W-2 is the official Form W-2. But there are quite a few other formats that are also approved by the IRS. So you shouldn't be surprised to see an entirely different format. That is okay as long as the required information is on the form. Now it is important that all the information on the Form W-2 reconciles back to the payroll register. That means that the total payroll register amounts for wages, pre-tax deductions, taxes, other deductions, and net pay should equal the amounts of all of the employee earnings records. The reason is that the IRS received the quarterly 941 reports and will definitely reconcile the numbers listed on the quarterly returns back to the Form 940 and the Form W-2s. Now let's look a little closer at the form. The Form W-2 shows the employer and employer IDs, name and address information, and the employee's taxable wages, tax withholdings for federal and state, as well as other deductions such as pre-tax 401k and health insurance deductions. Employees who stop working for the business during the year may ask that a Form W-2 be issued early, but employees typically wait until the beginning of the following year to receive their W-2s. Plus, it might be difficult to issue a form mid-year when the IRS has not yet published the form for that year. An important tool for both the employer and the government agencies to easily reconcile all payroll data is the Form W-3. Form W-3 is basically a summary of all Form W-2s and reports totals for wages and taxes withheld for all employees. Again, it's basically a double check that the total of all Form W-2s ties back to the payroll register. Form W-3 is due by the last day of February following the end of the calendar year and is submitted with Forms W-2 to the Social Security Administration. The Social Security Administration shares the tax information on Form W-2s with the Internal Revenue Service, which then in turn matches it up to the information on the employee's income tax return. So there are a lot of systematic controls in place to ensure that everyone from employees to employers comply with federal and state laws. Payroll is an area with lots of labor and payroll regulations. Employers often only see the part that involves their payroll, but there's so much more to it than just calculating payroll. Employers must ensure that paychecks are calculated correctly and issued on time, make sure that all withholdings and deductions are remitted timely to government agencies. Payroll tax returns also have to be filed quarterly and annually, and all these amounts must reconcile to the payroll register. Many of you will probably not be directly involved in the payroll process. Nonetheless, as accountants, you need to know the basics because payroll significantly impacts the financial statements, reconciliations, and compliance of the business.